Hey, good morning, everyone. Marty Mazzori here, 12th of August, 2022, with your weekly economic update and a quick stock market snapshot. And then nothing from me until probably next weekend. I'll be on vacation next week. So in front of you is the graph of our PWA, we call it macro index or general conditions index, and it still scores a 0. So we had literally no inputs that actually moved in one direction or the other week over week. And this would be the dividing line between expansionary and recessionary conditions. As I suggested last week, as we backtest, we've never gone below an 8 without ultimately ending up in recession. So our assessment right here based on this indicator would be that a recession in the relatively near future is a foregone conclusion, although of course we always remain open to all possibilities, as I like to say. And we certainly do live in unique times, to put it mildly. As for the inputs I want to feature this week, we'll start with weekly jobless claims, up again slightly week over week. This is not remotely a good look. Historically, when you look at the trend, we're still at relatively low levels historically, but it's the move and the rate of change that you need to be concerned about. As you can see here, the past says that this look typically leads into recession, which are these red shaded areas here. Continuing claims ticked up as well over the last week. The NFIB Small Business Survey for last month was released. Just a slight uptick, still very low in terms of optimism overall. Historically speaking, sure looks like recessionary conditions to me. Hiring plans ticked up just a titch. CapEx plans ticked down just a titch. The previous month was the lowest level since January 2013. Those that expect a better economy actually rose 9 points, but it's still very negative, minus 52%. And this is from the report. The uncertainty in the small business sector is climbing again as owners continue to manage historic inflation, labor shortages, and supply chain disruptions. As we move into the second half of 2022, owners will continue to manage their business into a very uncertain future. And I would put an exclamation point on that one, folks. The CPI data came out this last week. Wrote a lot about it during the week. Probably don't need to belabor it much. The headline came off the boil a bit to 8.5%. Month over month came in flat. A video that we shot right around last month's reading, I said that could very well happen. And I showed you how things were rolling over the second half of June. When you X out food and energy, the core was up 5.9. The month over month was up 0.3. All of it came in a little less than expectations, and the stock market just absolutely threw a party. Again, wrote quite a bit, commented on that, so I don't want to be too redundant here. Just to give you a little bit of the detail, the headline decline was driven by a 7.7% drop in gasoline prices. Energy overall fell by 4.6% during the month, still up 33%, while food was up another 1.1% month over month and 10.9% on the year. Services inflation, when you take out energy, was higher by 0.4% on the month. It's up 5.5% on the year. On goods core, prices were up 0.2% month on month, 7% year on year. Also out last week was the producer price index down here at the bottom. It came off the boil as well. Again, coming off of tough comparisons, you get this negative 0.5% month on month. You can extrapolate these things out. Politicians certainly will do that. Folks, you do not want to do that right here. Inflation remains a problem despite what the stock market might think, as I illustrated twice in the last 2 days. The fixed income market kind of sees things differently in terms of inflation prospects going forward. So which we'll see in the coming days, weeks, and months, which one has it right. Speaking of inflation and the prospects going forward, take a look at the Bloomberg Commodity Index. We called for a correction, got more than what we called for sure, and therefore we're getting a real nice rally right here in commodity prices as well. We are long-term, structurally very bullish on commodities going forward. And so you can see we have a new trend line right there, which very much looks like a bull market trend to us. So big snapback in commodities. We'll see how that plays out in next month's month-over-month reading for inflation. Raw industrial prices, you can see they seem to have bottomed and now resuming an uptrend for the moment. And then copper. Seeing quite the rally here off of these lows. I think that decline was way overdone. Quite the buying opportunity, I think, here for those who weren't in the metal or weren't in the miners. We'll see. I mean, this is going to be very, very volatile, no doubt, in the weeks and months to come. Longer term, we think it's virtually unavoidable for things like copper and the companies that mine them to do well for years into the future. Okay, so that's enough there for the economic update. Let's spend a minute or two on the stock market. Since it's already dialed up here, we'll start with the monthly chart of the S&P 500. Recall that this is what we think is the most compelling, that we've got a bit further to go, but we have had quite the rally. We are in the camp that says this is not the beginning of a new bull market, that it's a bear market rally, but it's been pretty good, folks. And remember, though, when we were calling for one back here, our bear market rally target was about 4,300. And as I speak at you right now, the S&P is at 4,250, so just 50 points away. We'll see. Here's the predominant downtrend line. We're beginning to test that right here. If we're right from this point here, before we really get excited, all things being equal, we've got about 17% to come off now after this nice rally here on the monthly chart. The basis for that analysis, if you go back 30 years, and this is just back 15 years, we don't have any false signals. Almost had one here, but each time outside of recession where we had our sell signal, we went down and tested and found support at the 50-month moving average. That's that 3,500 that we have staked out here. And when we're in recession, when we go back, we get bigger declines. We think a recession, again, looks like a foregone conclusion, but we think it's going to be relatively mild based on everything we know at this moment. And then I want to skip to the daily chart. Things that kind of jump out at me, folks, is that we're just about oversold here on the RSI, this spot right here, this red line. Notice when we were just about there here, we began this, this big sell-off here. We were, not quite there at the market peak. We were definitely there here. So these oversold levels should be respected, particularly when we're in what we think is still a bear market. But an optimist could get more optimistic here, right? We are through the 50-day moving average, and it's beginning to slope higher. I showed you the look here on the 2008 time frame that was pretty encouraging, and of course it all proved to be for naught. We are above this 50% retracement, and if we close above there, there's a lot of people out citing the fact that we've never had a bear market where we've come through and had some closes above the 50-day percent retracement, where we went back to the cycle lows. I take that entirely with a grain of salt. It's like saying in 2020, when we were 3 weeks into that official bear market because of the decline, frankly, it'll go down as a bear market in the textbooks, doesn't qualify by my standards. But nevertheless, you've never had one that lasted only 33 days. So I guess you're 3 weeks or say 30 days into it, you can say that this thing is not even close to being over because that's never happened before. Well, it happened. And it's like saying under these conditions, when you factor in the huge short interest that's supplying support, serious support for this market as it ramps higher, the options dealer hedging that we've talked about, which is net bullish right here, at least for the next week or so, you just happen to fall right here at a time when the underlying positioning suggests strongly that you could get a push above there. Now, could that kind of in reflexive action start something more meaningful to the upside? Sure, it could. Is it likely to? No, we don't think so right here just yet. 200-day moving average, the simple 200-day moving average, we think is going to be some pretty big support, and it falls right just above that 4,300 mark. Then you've got the downtrend. And I said support, I mean resistance. Then you've got the downtrend line to contend with as well. And you have next week's options expiration, where a lot of this bullish positioning and hedging is probably going to be unwound, and that could open the door for what we think is the next leg of this bear market. But again, none of this is for certain. We're always open to all possibilities. This looks really like a bull flag right in here. You take that to its target, which would be the length of this flagpole, and it gets you right about to there. So if this pattern plays itself out, it will play itself out right there at our 4,300 upside target. So interesting stuff. We'll see how it progresses over the next few days and weeks. And then lastly, we'll take a look at that very short-term 60-minute chart. We pretty much have more of the same, folks, and just kind of extend out. Maybe a new uptrend line there. Go back to here, and you have very much, here's this morning's few hours, very much your rising wedge, new high of this pattern right here, trying to fight back there. You also could see resistance right here at 42.50. And then you still have these divergences. This is the bearish divergence on the RSI. This is a real bearish look. Even though we continue to kind of flag, you broke down through here, but we caught wind again here the last couple of days with the CPI and the PPI numbers being a little less scary than expected, I guess. Break down below that wedge with some momentum, and you're going to have a problem. And once we get down below 4,100, there's really nothing saving you from 4,000. Then we start getting into problems with how the dealers are hedged with regard to the options, and suddenly they need to short to hedge their downside exposure. Right now, according to the people who we've hired to help us with these analyses, pretty bullish look right here. Unless we drop below 41.50, then there could be a flip and things could get pretty ugly. I was thinking earlier that today looked a lot like yesterday, where we started off nicely higher. Nick and I were chatting internally. We were discussing that it wouldn't surprise us to see that rally completely fade, and that's exactly what happened. One of the key differences, though, between yesterday and today is that the VIX, the implied volatility indicator, was pretty much elevated all day. And as I talked to you today, for the S&P, it's down almost 5%. So that suggests that this rally could hold through the day. And we may even get a nice last half hour boost, as the options dealers have to true up their hedges for the weekend. So we'll see, although there's still several hours left in today's trading, and I think that the smart money is probably scaling out of the market if they're seeing the things that we see. And then we're about to enter what could be a very problematic September. So folks, I'm certainly not complaining. I like what I'm seeing in our portfolios with these recent moves, but we have to look at the world for what it is and remain very, very objective. We're not going to see it how we'd like it to be. We're going to see it how we think it is. And right now, the risk-reward setup for stocks does not look positive for us right here. Therefore, with cash that we're sitting on, waiting for another opportunity, we're continuing to be very patient, if not stubborn right here. Now, we do have to recognize the possibility that the conditions that have us concerned could improve to the point where we don't have those concerns and we could be allocating cash at a higher level. We think that as long as we are always doing things consistent with what we think is a smart risk-reward assessment, it's not about the levels that we engage, it's about being engaged at the right time and under the right circumstances, always with a long-term perspective. I will leave it there, folks. You get a break from me over the next week, as I said, so I hope you have a wonderful weekend and a wonderful next week, and I'll be back soon enough. Take care. Bye-bye.